this lecture, we are going to look at mixed partnerships. Partnerships which consist of both partners who are individuals and partners who are not individuals, such as companies or trusts, are referred to as mixed partnerships. This chapter considers mixed partnerships which are made up of individuals and a corporate partner only. Corporate partners are often included as members of an LLP. In a mixed partnership, where one or more of the partners are individuals and one or more of the partners is a company, then two separate computations of the taxable profit or loss of the partnership are required per accounting period. The taxable profit calculated using income tax rules is used to allocate the relevant profit shares to the partners who are individuals for each accounting period. Each partner then uses the normal current year basis rules to allocate their share of this profit or loss to tax years. The taxable profit is then recalculated using corporation tax rules, as though the partnership were a UK resident company. The resulting taxable profit is then used to allocate the relevant profit share to the corporate partners for that accounting period. If the accounting period of the partnership does not coincide with the corporate partner's own accounting period, then the company's share of the partnership profits will be time apportioned to its own accounting periods. Let's look at this time apportionment using an illustration.
The Hodge & Co partnership has a year end of the 31st of March 2022. H Limited is a partner in Hodge & Co, and its share of the taxable trading profits for this year has been calculated as £200,000. H Limited prepares its own accounts to the 31st of December each year. In order to time apportion the partnership profits to H Limited's accounting periods, we need to compare the partnership's accounting period of the year ended the 31st of March 2022 with H Limited's corresponding accounting periods. 9 months of the partnership's year ended the 31st of March 2022 falls into H Limited's year ended the 31st of December 2021, which means that 9/12 of the £200,000 trading profits, being £150,000, will be taxed on H Limited in the year ended the 31st of December 2021. 3 months of the partnership's year ended the 31st of March 2022 falls into H Limited's year ended the 31st of December 2022, which means that 3/12 of the £200,000 trading profits, being £50,000, will be taxed on H Limited in the year to the 31st of December 2022.
There are a couple of points to take into account when calculating the taxable profits of the mixed partnership. Any partnership which includes a corporate partner is not entitled to the 100% annual investment allowance when calculating capital allowances. A partnership that includes a corporate partner cannot use the cash basis to calculate its trading profits, nor can it claim the flat rate expense for motor expenses. Following the introduction of the additional rate of tax and the abatement of the personal allowance for individuals whose adjusted net income exceeds £100,000, mixed partnerships became an attractive option for tax planning purposes, particularly for those who wanted to avoid paying tax at the additional rate. The insertion of a corporate partner also allowed additional flexibility due to the remuneration strategies available to a company. As a sole trader or partner in a partnership, an individual is taxed on their share of the tax-adjusted profits earned by the business at 20%, 40% or 45%, regardless of whether or not those earnings have been taken out of the business. By introducing a corporate partner, some of those earnings could be diverted to the corporate partner, where they would be taxed at the lower corporation tax rate of 19% and Class 4 NIC would be avoided. Remember that in a partnership, the partners can agree to whatever profit-sharing allocations they wish. In addition, the profits could then be extracted from the corporate partner by way of dividends. The effective rates of tax on dividends in the basic, higher and additional rate bands were considerably lower than the rates of tax on trading income. Funds which were allocated to and taxed on the corporate partner could be left in the partnership rather than actually withdrawn by the corporate partner and used to fund working capital or new capital expenditure. The introduction of a corporate partner who pays a lower rate of tax enabled more funds to be retained in the partnership. Therefore, the use of a mixed partnership could result in significant tax savings. HMRC were concerned by the increasing number of businesses which used the flexibility of the partnership profit and loss sharing arrangements to secure tax advantages in a mixed partnership. Consequently, anti-avoidance rules were introduced to combat this practice. These anti-avoidance rules apply to all mixed partnerships, including limited liability partnerships which have a corporate member. The legislation deals with three types of arrangement. The first anti-avoidance rule looks at profit allocations to corporate partners. The second rule looks at loss allocations to individual partners. The final anti-avoidance rule relates to all partnerships, not just mixed partnerships, and combats tax avoidance from the transfer of income streams and assets through partnerships. We will look at each of these three measures in turn. As we have seen, individuals could reduce their tax liability by diverting all or part of what would otherwise be their normal profit share to a corporate entity, which would nearly always be charged to tax at a lower rate than the individual. The effect of the anti-avoidance rules is to reallocate profits from corporate partners to individual partners where certain conditions are met. Broadly, the legislation applies where individual partners divert partnership profits to a corporate partner in order to reduce tax on their profit share, while still retaining the power to enjoy the profits. The legislation is contained in ITOIA 2005 at sections 850C to E. The provisions apply when the following conditions are met. A corporate partner has a share of the partnership's profit and the corporate partner's share is excessive. In other words, the corporate partner's profit share exceeds an appropriate notional profit. An individual partner has the power to enjoy all or part of the corporate partner's share, and it is reasonable to assume that the effect of the profit-sharing arrangement is to reduce both the individual's profit share and the aggregate tax payable. Let's look at some of these terms in more detail. The appropriate notional profit is the profit the corporate partner is deemed to have earned from the partnership by providing capital or by providing services to the partnership. From this figure, we deduct any amounts actually received from the partnership for providing the capital and/or the services. The return on capital is calculated at a commercial rate of interest. The consideration for any services provided by the company to the partnership should be calculated at arm's length. If any services provided involve other members of the partnership, then the value of these services is not included in arriving at the notional profit. For instance, let's assume that Andy and Burrows Limited are members of Hedgerow LLP. Burrows Limited provides advertising services to Hedgerow LLP, but the work is carried out for Burrows Limited by Andy. The provision of these services would be ignored when arriving at the notional profit. An individual partner has the power to enjoy the corporate partner's profit share if they are connected with the corporate partner other than by being members of the same partnership, or they are party to arrangements, the main purpose of which is to ensure that the corporate partner's profit share is subject to corporation tax rather than income tax, or one of the enjoyment conditions is met. The enjoyment conditions are met when the company's profit share is anticipated at some time to be for the benefit of the individual, or any part of the company's profit share increases the value of any of the individual's assets, or the individual is entitled to receive any benefit, directly or indirectly, out of the company's profit share, or the individual is able in any manner to control, directly or indirectly, the application of the company's profit share. For example, if an individual partner were a shareholder in a corporate partner, then the opportunity to receive future dividends from the company's income would constitute the power to enjoy the profit. When considering whether the enjoyment conditions are met, we must also consider any person connected with the individual. So if Scott is a member of a mixed LLP, in which S Limited is also a member, and S Limited is owned by Scott's children, then Scott would have the power to enjoy the profits allocated to S Limited under these rules. Where the provisions apply, the individual's profit share is increased by the amount of the company's profit share that is attributable to the individual's power to enjoy it. This amount cannot exceed the amount by which the company's profit share exceeds the appropriate notional profit. The company's profit share is reduced by a similar amount, although account must be taken of any differences in computational rules for corporation tax and income tax purposes.
Brad & Co has a year ended the 31st of March 2022. Profits are allocated 1/3 to Brad and 2/3 to B Limited. B Limited is wholly owned by Brad.
After the necessary tax computations have been prepared, Brad has taxable profits of £100,000 and B Limited has taxable profits of £200,000. B Limited does not provide any services to the partnership, but it has made a £500,000 non-interest-bearing capital contribution to the partnership. We are going to calculate the amount of profits to be reallocated from B Limited to Brad. Firstly, we need to determine whether B Limited's profit share is excessive. The notional profit that B Limited is deemed to have received from Brad & Co is the return on the £500,000 loan made to the partnership. Applying an interest rate of, say, 4% to this loan would mean that B Limited would be entitled to notional profit of 4% of £500,000, which gives £20,000. Since B Limited was actually allocated £200,000 of profits by Brad & Co, this profit share is clearly excessive. Brad has the power to enjoy B Limited's profit share because he is connected with B Limited, since he owns more than 50% of the shares in B Limited. Given that B Limited is owned by Brad, it is reasonable to assume that the effect of the profit-sharing arrangement is to reduce both the individual's profit share and the aggregate tax payable. As a result, the excess profit of £180,000, being the £200,000 allocated to B Limited, less its entitlement to notional profit of £20,000, will be reallocated from B Limited to Brad for tax purposes. This leaves B Limited with a profit share of £20,000, which equals the notional profit figure we calculated, and Brad with a taxable profit share of £280,000. Where there are several individuals who are partners in the mixed partnership, this excess profit will need to be split between the individual partners on a just and reasonable basis. In such a case, the reallocation would be fact-specific, but would seek to put each individual in the same position that they would have been in the absence of the power to enjoy arrangements. HMRC guidance states that relevant considerations would be the extent of the individual partner's shareholdings in the corporate member and any informal agreements between the partners. In the absence of any other detail, the starting position would be to reallocate the excess profit using the same proportions as the individual's actual allocated profit shares for the accounting period prior to the reallocation of the excess profit. Although the reallocated profits are taxed on the relevant individual partner or partners, the profits remain in the hands of the corporate partner. These profits can then be taken out of the company by the individuals without any further tax being due when received by the individual. Equally, the payment is not allowed as a deduction in calculating the company's taxable income or treated as a distribution. If partnerships do not want to have to apply the anti-avoidance rules, then they could consider incorporation or adjusting the corporate member profit shares to a justifiable level. This concludes the first part of the lecture on mixed partnerships. In the next part of the lecture, we will look at the two remaining anti-avoidance provisions.